So very good evening to all of you. Let us start today's presentation, which is going to be on what are the nuances which are applicable for foreign remittances, and it is not going to be a similar to what generally we talk about. What is 195, etc. What I have covered over here is all the practical case studies and practical issues which are arising across in foreign remittances in today's modern world, where we have a lot of online payments which are there. We have a lot of transactions which are newly and innovatively introduced, so all those transactions is what we are going to cover across, and we are also going to discuss what are the tax implications of that. So without wasting much of the time, let's go on to some of the basics and then we move on to the case studies. So purposefully, I've kept the case studies as more important because I want to cover more case studies which are related to online payments, etc. So with 195, broadly, we are aware of it is mainly for a payment to a non-residence where it is chargeable, some which is chargeable to tax, right? So it is applicable only when it is a payment to non-resident where the amount is chargeable to tax. This is a small snapshot of when it is taxable, when it is not taxable for resident and non-resident. So that's something which we broadly are aware of. These are some relevant provisions uh, which is a co-existence of two statutes, so Income Tax Act and treaties. So if we go to Section 911, the corresponding articles are of the treaties are what a comparison is what we have drawn over here for the better reference for future. Now, here basically what we are trying to say is what is not deemed to be taxable in India. So what is not deemed to accrue or arise in India. That is what is covered over here. So what is not deemed to be accrued or arised in India. Broadly, we are aware of that anything which is paid from India to a non-resident outside India, as long as it is for the business which is outside India. So if I'm making a payment from India for my business which is going to be outside India, and for that, if I'm making a payment to a non-resident, and that is not deemed to accrue or arise in India, right? So if you see the payments by a non-resident, so this is one thing where payment is by a resident. So if a payment is by a resident, if it is anything related to outside India, business outside India or income from other sources outside India, which I'm going to generate, the source of income which is outside India, that is not taxable in India, and therefore TDS is not applicable. Now let's also take an example of payment which is made by a non-resident, right? Now, if the payment is made by a non-resident, other things remaining the same, only one difference which needs to be looked into is that if that particular non-resident is making a payment and that is related to a income which is not from a business income but from other sources, and that is a source which is even in India, because the payment is made by a non-resident, that is still not taxable in India because it is not deemed to accrue as in India, because the payment is made by a non-resident and the income will be taxable in respectively. So it won't be taxable in India because it is a payment which is by a non-resident. So this is one difference point which I need to wanted to bring it up to your notice, and therefore it is highlighted. Now, largely, we have three major provisions which are important. So one is business connection, one is royalty, and third is fees for technical service. So these are three important provisions which are applicable when we look into any transactions for foreign remittances. Now, how generally we do the transaction analysis? So taxation implication, first we go to domestic act. If the domestic act itself is not taxable, if it says it is not taxable for a non-resident, when I'm making a payment to non-resident, mind you, income is of a non-resident, not of a resident. So when I'm making a payment to a non-resident income is getting determined whether it is taxable or not taxable. So what I first see is whether as per the domestic law, that income is taxable or not taxable. Let's say the answer is not taxable, then straight away out we say that that amount is to be remitted without paying any taxes. However, if we say that as per domestic law it is taxable, then we go to DTAA. And then we check that there is a double tax treaty between the two governments. And as per the treaty, whether it is taxable in India or not India. So that's how we analyze the transactions when it comes to foreign remittances. These are basic things which I just spoke about, that when you look into the payments which are made to a non-resident, you first look into the income tax set and then you go to DTA to check whether that income is taxable or not taxable as per income tax first. And then you go to DTA and check whether it is taxable as per DTA or not. And accordingly, you determine your tax liability. When you go to DTA. So now the question is, how do you look into the DTA? So I'm just going to describe you how, for your easy references, how you should look into the DTA. So from a DTA perspective, first you see is where is the residential status. So the DTA, as per the DTA, whether you are resident of India or you're residents of, let's say US as an example. So then you go to the next step to check whether it's a professional services or not. Because if it's a professional service, then there's a separate article which you deal with and check whether as per that article you are liable for tax in India or not. If it is not a professional fees, because they are specifically defined, for example, engineers, architects, doctors, etc. All these people are basically qualified to be a professionals rendering a professional service. So if you are falling into that category, there's a specific article which deals with the taxability of that, which we'll be covering later. But that's a specific articles, and therefore you will see from that perspective. However, if it is not a professional service, let's say the answer is no, then you will seek the next step whether that particular entity which is rendering the service. So, for example, there is a company called ABC Limited, which is providing a consultancy services. You will see whether that particular service is having a PE in India, whether they have a business connection in India, whether they have some setup in India. If yes, then because it has a P in India, therefore that amount will be considered as business profit and it will be taxed accordingly. Now the answer is no. Let's say that particular foreign entity is rendering a service from outside India only. They don't have any existence in India. Let's say in that particular case, you will see whether it is a royalty, the payment which I'm making, whether it's a royalty, whether it's a fees for technical service, or whether it's a interest payment. What is the nature of payment? And accordingly, the article will apply. So that's how you have to read the DTA. I'm just giving a brief idea about how the DTA should be looked into when you're making a foreign remittances. Straight away moving on to the case studies, because these are important for us to discuss today in 1 hour. Now let's say there is one payment which I'm making. So I'm just giving this case study and I'm just explaining you the brief about the case study. Now what happened in this case study, it's an export business for understanding a new market. Let's say I'm exploring a market of European countries in this example. So there was an European countries which I wanted to explore whether I should do the business over there, whether my product will be accepted, who are the competitors, what is the margin, etc. I wanted to do the analysis of that particular market. So I appointed somebody in European countries to do that particular market survey. Now after that market survey, I decided I want to export my products to that country, and therefore I started my export. Now, for that market survey, let's say $1,000 is what I paid to the £1,000 I paid to the European country. Let's say. Now, whether that particular amount which I paid to the European entity, whether that will be taxable in India. Now, let's analyze that transaction. So, when we analyze this transaction, the question is, I made a remittance to a European country. Now that European country, whether that European country is the European entity, I'm sorry, European entity, I'm making a payment to a European entity. Now the question is that payment whether is taxable in India or not. Now, as we started by saying that first we need to go to Income Tax Act. Now, what Income Tax Act says that if the payment is made for a purpose of business outside India, then that particular amount is not deemed to accrue or arise in India. Now, when it is not deemed to accrue or arise in India, therefore it is not taxable in India. That is what the section is saying. Therefore, what is important to look into over here is whether this particular payment which I am making is for the purpose of business outside India. Now, if you generally look into it, you will say, yes, it is for the export business and therefore it is for the purpose of business outside India. But that's not right. Why is it not right? I'll tell you that. It's a very thin line, which very nicely brought out by Delhi High Court and then subsequently have been followed. What it says is there is a difference between transaction sourced and transaction received. So if a particular export business, where is it sourced? So the activity related to export, because it is carried out in India, we will say that it is not for the business outside India, it is for the business in India, because the source, the activity of that business is carried out in India. So in that situation, since the source of the business is in India, it is only that the person who is buying the product is outside India and he is remitting the money from outside India. That is the differentiation which is created by this high court, and they ruled it against the taxpayer, saying that here the amount is taxable in India because the activities are carried out in India, and therefore it is not for the purpose of business outside India, it is for the purpose of business in India, and therefore it is taxable. Am I clear? If you still have a question, you can post it into the Q&A and I'll answer those questions later. Now let's take the second example. This is another example which is contradictory to this example. Just give me 1 second. I'll just pause for a second. Yes, I'm sorry. So now we move to the next point. The next point is Bajaj case law. So this was a case law which was of Mumbai Tribunal. This is completely a different analogy which has been brought out in this particular case law. Now let me brief you what is the facts of this case. Here also, what I wanted is I wanted to set up a branch in Brazil. I wanted to have an expansion of my business. I wanted to set up an entity, not a branch. I'm sorry. So set up an entity in Brazil. And for setting up that entity in Brazil, I took a service of KPMG for giving certain services related to formation of the entity over there, etc., etc. Now the question again, the same question I'm raising, is it for the purpose of business outside India? The answer is, in this case, answer is yes. Why? Because I am setting up an entity in Brazil. Now that entity is a separate entity. And because it's a separate entity which is going to carry out a business in Brazil, therefore, the payment which I'm making to KPMG is for the purpose of business outside India, and therefore it is not deemed to accrue or arise in India, and therefore, as per income tax itself, it is not taxable. So you need not have to go to double tax avoidance treaty, because the tax itself, the domestic law itself, does not tax the transaction. To summarize this point, what I'll just summarize it in this way, that if there is a non-resident, I am making a payment to a non-resident. I am a resident. I am making a payment to a non-resident. First thing what I'll see is that what is this payment for? Is it for the purpose of business outside India? If the answer is yes, then we can say that it's not deemed to accrue or arise in India. And therefore, the next question is, what is business outside India? So you need to see where this activity related to the business is going to be carried out. If the activity is going to be carried out in India, then it is sourced in India and it is not for the business outside India. If the activities are going to be carried out outside India, then it is sourced outside India and therefore it is for the business carried out outside India. With this example, this concept gets cleared, and therefore it is very important that while you make the remittances, you may not tax it. Why I take this example is because I've come across a lot of such cases where the tax is being paid, and subsequently in the audit this gets picked up that this was not supposed to be deducted. The tax was not supposed to be deducted, and that becomes the tax cost for the taxpayer in India. Because generally, all the foreign companies largely they want the tax to be at remittance to be at the gross value, which is at a bill value. So if there is any tax, that tax to be borne by Indian entity. I have come across a lot of such cases in audit where these transactions have been taxed and the amount is remitted. Now, this is therefore I have brought this as the first case study for us to understand that there is a difference. Okay. Yes. Now moving to the next point, which is royalty. Now, here one important thing which I want to bring it up to the notice of people is that under Income Tax Act, the definition of royalty, and under the double tax treaty, the definition of royalty, there is one very important difference. That important difference is it says that imparting, if you just go on to the highlighted point number 4 or point number 5, which says imparting of any information concerning technical, industrial, commercial, and scientific knowledge, experience, or skills. Now, therefore, what it says is it says that it is imparting of any information. Now, Income Tax Act is very broad to tax a transaction even if you are imparting an information. However, in the double tax treaty, it says imparting of experience. Now, this is the difference. If you say that it is imparting of information, that means if you are even sharing an information that results into definition of royalty as per Income Tax Act. However, DTA says only if you are sharing your experience, then only it is basically uh, covered under royalty. So this is one basic difference between the two treaty which one needs to keep in mind. Okay. So now the next question therefore arises that whether royal software, this is a very common question which comes across more or less now it has got settled, but earlier there was a lot of ambiguity on this part. Largely it says that whether the software license which we receive, whether it's a royalty or not a royalty. Now therefore the question, the answer to this question which has been dealt by series of courts ruling is that whether it's a copyrighted article or copyright. Now let's understand what is the difference between a copyrighted article and copyright. One difference, let's say if I am giving you a rights, let's say you are in India, I am in a foreign country. I have a proprietary of a particular product or particular database or anything related to which I want to license you. Okay. I have the proprietary of that. Now I am allowing you only to further license it, but not by doing anything, only doing marketing. So if you are doing only marketing, whoever is the new customer, it is coming under on my particular database. He's getting logged in, he's paying for that, and he's getting the access to my database. So what are you doing? You're doing only marketing. Okay. I have not licensed you. I have not given you, I have not shared my proprietary rights with you. So therefore, it is a copyrighted article. However, if I am allowing you to further license as per the agreement, to further modify or to further duplicate that particular database, okay, therefore I am giving you a proprietary right to come along with me. Whatever rights I have, I'm sharing my proprietary rights with you to modify it, to duplicate it, to further license it. In that particular case, it's a copyright. Okay, so this is a very thin basic difference between the copyrighted article and copyright. Now, if your agreement is clearly demonstrating that it is a copyright, then it is a royalty. If it is saying that it is copyrighted article, then it is not royalty. That's the simple point we need to understand. Moving next, so this is the same thing what I have described you. That's the same thing which has been explained in this particular case laws. Moving to the next point. Yes. Uh, okay. Any consideration for, okay, now this is again an interesting point which is there in the Income Tax Act itself as a relief, as the exemption. But lot of people are not aware about this exemption. And therefore, I just highlighted this point. What it says is any consideration for rendering any managerial, technical, and consultancy service. This we all are aware of, but does not include consideration for construction, assembling, mining, or like projects undertaken by a recipient on consideration which would be income of the recipient under the head salary. So what it says is that it does not include what? A, construction, assembling, mining, and or like projects. So therefore, if suppose there is a foreign company who is carrying out an activity which is assembling activity in India, so there is a service which is provided, which is only to assemble. And for that service, if I'm making a payment to foreign company, now that is not taxable as per Income Tax Act itself. Okay, they have relieved this particular thing. However, if let's say I'm doing a supervisory service, now that's not assembling. I am doing a supervisory of that. Okay, so that's again a supervisory service. So there's a thin line of difference which we need to keep in mind that it is a supervisory service, assembly service is different. Now, if you're doing an assembly services, The act itself has given a relief that it is not taxable. So foreign payment for an assembling services or for a construction services or for a mining services is not taxable when it is in the nature of service. It's nature of consulting. Generally, the nomenclature what I have heard is because it is a technical service or because it is a consulting services. According to 9.1, it is taxable, and therefore we have deducted TDS on that. But go deeper into it and understand that because of this exclusion available, you can take the benefit of that. So that's something which I wanted to bring it up as an interesting point. Next is make available versus not make available. Broadly, if suppose there is a designer in foreign country, he is teaching me or my company employees how to make these designs. Then what is he doing? He is making available that technology to me. Okay, based on which my employees and myself can create similar designs in India. So what is he doing? He is transferring his experience to me. That's one. Now let's go to the second one. So this is a make available service. So there have been a lot of developed countries treaty where government of India have agreed upon that if they are providing the services which are purely consulting services where they are not transferring that experience to me, or in other words, I'm only getting the service. I can't duplicate that service in India. I can't render this tomorrow onwards. I can't go and start rendering the same services because I don't have that technology. I don't have that experience. And he has neither shared that experience to me. In that particular case, I cannot consider this to be a make available service, and Indian government does not have the right to tax it to US. Example US. So let's say a US citizen or a UK citizen or a Singapore citizen, if he is rendering any technical service in India, it is not taxable. Why? Because it is not rendering it in a form of a make available service. It is rendering only in the form of consulting, pure consulting service. So this minute difference is what we need to keep in mind. Moving next, uh, routine expenses. Now, this was a very good case which highlighted a lot of matters were relieved because a routine repairs. Let's say, for example, there is a in this case law, it was basically the airline companies who were getting the routine oiling done or some technical oiling done, which repairing work, which is a routine part of it. They said that because it's a routine activity, it is not a technical service. Okay, so therefore, these two case laws are trying to say that because of the technique, because of a routine services where the airline oiling activity, machining activity, etc., is been done, it is not taxable. So then the next question which arose is that if there are large tons of air conditioning, and let's say if suppose they are coming over here and doing some routine repairs over there, and if we are making a payment, whether it is taxable, answer is no, it is not taxable. Why is it not taxable? Because it's a routine repairs. If it is a specialty service where there is some experience, some technical skill sets are required, then it makes the difference. So that one thing which need to be kept in mind. Reimbursement of expenses very clearly if it is pure reimbursement. So there's a foreign entity, let's say foreign distributor. Now that foreign distributor has, I have taken their services. So if suppose I am an exporter, now as an exporter, I have appointed a distributor, let's say in Dubai or in Saudi. Okay, in Saudi I have appointed a distributor. Now I want to market my product. I want to bring awareness about about my product. So what my distributor is doing, I have given him a budget of 10 crore of rupees and said that you go and do a marketing of my product. Now he's going into the market, doing all the activities which are related to bringing awareness of my product. Now that 10 crore rupees is he's claiming it from me because I have given him the power to do that. He's claiming out for me and I'm making a remittance of that. Now, what is important to see is it a pure reimbursement? If the answer is yes, I'm sorry. If the answer is yes, it is pure reimbursement. Whatever is the amount which is billed by the vendor to the distributor, that same amount is charged to me. Then in that case, it is not taxable in India. Okay, because it's pure reimbursement, it does not have a characteristics of income. Clear? So that's one thing which needs to be looked into. Now, I came across one case which was an interesting case. There's a foreign company which is my own subsidiary. Okay. Now, my own subsidiary, and that subsidiary is having this particular service getting done. And that service is what is getting reimbursed from me. Now, the question is whether that kind of a transaction also is a reimbursement and pure nature of this. Now, there is a bit litigative because it's a group company. A group company is in further getting a service done from the foreign company, from the foreign vendor, and it is reimbursing from me. And therefore, the question is it a pure reimbursement? Here, there is a bit of ambiguity, but yes, there is a practical decision, practical calls also which have been taken that there is no difference whether it's a third party or a group company. But just because it's a group company, there is a level of suspicion which is getting raised that is it a pure reimbursement or not. But if you are able to demonstrate that it's a pure reimbursement, then of course you can take it as a reimbursement of expenses, make a remittance without taxation. Yes, so we are done with reimbursement of expenses. Now we are going to the next part of the transaction, which is secondment. What happens in secondment? Now nowadays there's lot of people from India going outside India because we have lot of intellectuals in India. So there is a lot of hiring of intellectuals which is happening outside India on a secondment basis, and more specifically in countries like Dubai. Okay, a lot of people from India goes over there, set up a factory, be there for maybe 2 years or 3 years, and then come back. Similarly, because of make in country concept, like we have a make in India concept, every countries have now started having make in country concept. Now, therefore, initially, so let's say pharmaceutical company, what they were doing is they were exporting from India. So all the manufacturing was happening in India, and then there was exported, and there was a distributor who was distributing that particular product. Now, because of make in country concept, what has happened is Indian manufacturers have to set up a factory over there, okay, to manufacture there so that it becomes a make in country and it gets a permission or a license or a rights to distribute in the home country. Now, for setting up a factory and for making it running and establishing or stabilizing that factory, I need to send somebody from India, second it over there, stay it over there, do that activity, and then come back. Maybe 3 years, 5 years, etc. Now, in this case, the question is, what is going to be the tax implication for the salary which I'm paying to that particular employee in India? Let's say he's having an Indian account. I'm paying him in an Indian account. He's using it for his household expenses for the family which is there in India. What is going to happen? Is it going to be taxable? The answer is no. Why is it not taxable? Because this particular service is rendered outside India. So if the service is rendered absolutely outside India for the purpose of business outside India, then we can say that it is not taxable in India. Now the next question is, and this is mainly because the person is non-resident. Okay, because when he's going outside India, he becomes a non-resident. Based on that, we are talking about this. Now go to the next point. Next point is, okay, here the somebody may argue that Darshak, it is received in India. So if it is received in India, why is it not taxable? Because we say that money which is received in India, accrued in India, deemed to accrue or arise in India. These are the three conditions based on which we said it is taxable in India. Now here the money is received in India. So if that is the argument, then the next point is going to be what? We go to DTAA. DTAA, if you go to specific article, which is Independent Personal Service, Article 14, it clearly says that there are three conditions which needs to be satisfied. The first condition is that you should be staying in India for 183 days. Now, here, if you have stayed outside India for 183 days, you are not satisfying that condition, and therefore, as per the treaty, you are being taxed in the home country, which is the let's say in this example Dubai. So if it is taxable in Dubai, you are not having a taxability in India because you have stayed in outside India for more than 183 days. So that's the reason, even if the money is received in India, because the service is rendered outside India, because the person is staying outside India for more than 183 days, it is not taxable in India. That's the point. Okay. Moving forward to the next one. Let's say the reverse situation. There is a person who is coming from outside India to India. Now that's a tricky issue because there are a lot of other factors which needs to be looked into. let's say somebody from Germany, we have a factory which has been set up in India. We don't know how to use the machineries. They are all automatic new equipments which we have installed in India. Okay. I am taking a service of a foreign company who are the manufacturer of machines. They are sending their employees in India. I'm using the word sending their employees in India. They are staying in India for X number of period, which is a longer period, and they are establishing those machineries. They are training my people how to use this machinery. They are giving me the manuals on how to use this machinery. And if for that, if I am making a payment to my foreign enterprise, okay, from whom I bought this particular machinery, the question is whether it is a service. Answer is yes, it is a service. Whether it's a make available service, if the service is make available, then yes, it's a make available service. Whether it is taxable, answer is yes, it is taxable because it's a make available service rendered in India. Okay. So therefore, it is taxable in India. Now let's take the second example. There's a person who has been seconded in India. He is going to stay in India, but I have, as an employer, Indian company is going to monitor, supervise, do everything related to that employee in India. I'm going to be the responsible person if anything goes wrong. Foreign entity is no more responsible. He has seconded the person in India. So the foreign employer is now, there is no employer-employee relationship for a temporary period. And therefore, the question is that whatever money which I'm paying to the Indian person, whether it's taxable in India, answer is yes, it is taxable in India because the service is rendered in India. The person is being in India. I'm going to be an employer-employee relationship, and therefore the payment which I'm making to him will be liable for tax in India if he's going to stay for a longer period in India. Now the next question or next situation. The next situation can be that person has come to India. I'm having an employer-employee relationship, but I'm not making a payment to him. I'm making a payment to the parent company. That company is making intern payment in the home country to their home account to that employee. Okay. Now I have not made a payment to employee. I have made a payment to foreign company. Foreign company has made a payment to employee. Now is that taxable? Answer is yes. In my view, it is taxable because the services are rendered in India. I am carrying an employer-employee relationship, and therefore this transaction is going to be taxable in India. There can be an argument it's a reimbursement of expenses. I agree. There's a possibility of we arguing that it's a reimbursement of expenses. But what is more important to look into is that this expenses has been claimed by me. Employee is rendering the service in India. I am having an employer-employee relationship. So in this situation, it is because that employee is in India, government of India has a right to tax that transaction. And therefore, I'm saying it is taxable, right? So these are the three different situations, or maybe 4, 5 different situations, which will decide about the taxability as far as the secondment of people are concerned. To summarize this point, to summarize, I'll put it up in this way. First thing what we need to see is that whether the amount is accrued in India, whether the amount is deemed to accrue or arise in India. So to see it whether as per the Income Tax Act, whether it is taxable or not. Then we go to DTA and we go to Article 14 largely. If I'm not wrong, it is Article 14. It says independent personal service. Now there you have to see that as per the treaty, whether the three conditions which are mentioned over there is satisfied or not. If it is getting satisfied in favor of person to be taxed in home country, which is in foreign country, then it is not taxable in India. But if these three conditions are getting satisfied from in favor of Indian government to write to tax, then that goes to be taxable in India. So this is the condition. This is the check which we need to do when we are making a remittances for salary for the seconded employees. Moving next, I'm done with secondment. I have taken up all these important elements. Yeah, is related to secondment. Now we move to the next point. We are at 5:37. I have another 20 minutes to discuss, and then we will open for question answers. Uh, Now I have defined certain. I have arrived at certain transactions which are applicable in our day-to-day life, and I want to check whether this is taxable or not taxable, and we understand that whether this is taxable or not taxable. So, raw material purchased from foreign country or equipment purchased from foreign country, the answer is it is not taxable provided the title of the material or title of the equipments are transferred outside India. So if suppose there is a foreign vendor from whom I bought an equipment, I bought a machinery. Now, if while the equipment is getting shipped and till the time it is on the dockyard of the foreign country, if the vendor is transferring the right or the risk of that particular machinery on me, and from the dockyard of foreign country till the machinery comes to my godown or my factory, if the risk is belonging to me, then the material is said to be sold outside India, and therefore it is not accrued or arised in India. Now let's take a second situation where the material, the equipment is not transferred, the risk is not transferred outside India. The equipment is shipped to India, it is getting installed in India, and till that point of time, if anything happens to this machinery, then vendor is responsible. Then in that case, it can be argued that it is for the risk is getting transferred in India, title is getting transferred in India, and therefore sale is accrued and arised in India. Clear? Am I clear? Right. So then in that situation, it can be taxable in India, but otherwise it is not. So largely the agreements are derived or drafted or determined or commercial agreed in such a way that it is actually the title gets transferred outside India, and therefore in that case it is not taxable in India. Software I have already covered. MS Office licenses, etc. Now, what has happened is because in India there are distributors and distributors pay the tax. Therefore, Indian users are not supposed to pay the tax because the distributor has already paid tax on that particular transaction. SaaS subscription. Now, the SaaS subscription is basically attached with the services. Now, if that services, let's say, for example, a software as a service. Now, there is a machinery in India. For utilizing that machinery, I have bought a software from the vendor. Now, if it is intrinsically linked with the software, with the equipment, just to take a simple example, I bought a computer and Quickhill is already installed. Okay. Now I have not paid separately for Quickhill, just as an example. Okay. I have not paid it separately for Quickhill. So what has happened is that Quickhill software is intrinsically linked with the computer. I'm not paying him separately. And therefore it is not taxable because I have bought an equipment. I have not bought a software. But let's take a situation where I have bought a computer, but I need a specific software, which is a high-end software, which is not intrinsically linked with the computer, and I am separately buying it out. And with that software, I'm using certain technical service of that person. That is a SaaS model, which I'm talking about over here. In that situation, it is going to be taxable. It can be, it may be, because you need to see the DTA. But as per income tax, it may be taxable in India. Okay. Then you have to go to DTA and check whether it's a make available service, not make available service. That's what you need to analyze. But accordingly, it is going to be taxed. Next is technology license payment. Okay, so that is taxable. Of course, it's a royalty and therefore it's taxable. Intellectual property licenses, it is taxable. Franchisee and brand licensing, it is taxable because I'm paying a royalty for a brand, utilization of brand. Therefore, it is taxable. Licensing fee, licensing films, TV shows, etc. for broadcasting. Now this has become very famous, like Netflix, etc., where there are a lot of platforms available. We have a lot of platforms even in India. Okay, so if there is any content which is produced and that particular production house or that particular producer is licensing that particular rights to the broadcasting company, in that particular case, whether that particular payment which I'm making to that producer is covered under royalty, answer is yes. Database, yes. Now this is interesting. Let's say there is an oil price collecting company. So because we know there's a lot of fluctuation daily basis in the oil prices country by country. So, and there are series of different varieties of oil. Now, all these companies, all the database is captured in one particular software, and whoever wants to have the access to this uh, particular information, okay, he is allowed to log in and get this information on a daily basis. Now, when I'm making a payment for this, whether it is taxable, answer is it is not taxable. Why is it not taxable? Because of two reasons. One reason is because this is largely available for public. It is not specifically available for one person. That's number one. Number two, I am not allowing him a proprietary right by him to log in. He's just having a license to access this particular information. He can't do anything with this information. He's just allowed to download the PDF copy of this particular document at the most. So because he is not having a proprietary right to this particular database, okay, therefore it is not royalty. So these are the two reasons because of which it is not royalty. Spectrum usage fee for telecom companies. So now, because of 4G, 5G, etc., telecom companies also have been giving rights to this. So now the question is, in this case, if they are giving me the license to use that equipment, why is it not taxable? It should be taxable because DTAA itself says that for the use of equipment, if I'm making any payment, it is royalty. Then why is it not taxable? The answer is there is a difference between use of equipment per se with a proprietary right, and second is use of equipment as general for public at large. So let's say there is an equipment available where whomsoever pays for it, okay, is able to use that equipment. But they does not have a proprietary right to use this equipment solely, wholly, exclusively, conclusively. These rights are not available. In that particular case, I don't have the proprietary right to use that equipment. I'm only having a general power because I'm getting the access of it. I'm allowed to use it. Therefore, the courts have said that there's a distinction between the two, and therefore it is not taxed, right? So, though it is a use of equipment, but because I don't have a proprietary right to use that equipment, therefore it is not taxable. Clear? So there's a thin line, and these are all arguable points which we need to keep in mind that we need to defend. This should be used it in such a way that an awareness of these laws is important, but at the same time, we need to keep in mind that these are all arguable matters, but are all debatable matters, and therefore one need to use it as caution whenever he is using it with all full awareness of the fact that this can be a matter of litigations, whatever I'm right now talking about. License for educational and content, the training content. Now there is a decision on this, which is Delhi Tribunal, which says that payment received from Indian customer for access to the online platform do not qualify for fees for technical services, as the services are standard services and not customized services and does not involve any technical transfer, right? As I said before, it's a generally available information at public at large. Whoever wants to use it can use it. And therefore, it is not a proprietary transfer of rights. It is only a general allowance of use of the particular database or content or equipment, and therefore it is not taxable. Manufacturing and distribution license, if you have a specific brand which you are allowing to use it, and therefore for the royalty is paid, answer is yes, it is taxable. Gaming and interactive. Now, because there is a lot of demand for the gaming business, gaming market is popularly increasing nowadays. If suppose a platform is created, on that platform anybody can come, create his own games and sell that games. Now if that platform is available for somebody to develop that particular game, and if that person is having a right to use it, change it, do a lot of activities in and around that platform for him to make a proper game, that is going to be a proprietary power allowed to that particular company, and therefore it is royalty. Whew. Now next, okay, I think just give me 1 second. Yeah, I'll go first on this slide. For a consulting services, what is taxable and what is not taxable? So one thing, some of the important parameters one has to keep in mind when he is going from a consulting perspective. In consulting, let's say service for business, what needs to be examined? How to analyze whether a consulting services is taxable in India and TDS is applicable or not. Step one or test one. Test one is whether the service is for business in India or for a business outside India. That's the first thing. Test two Whether the service is a make available service or not a make available service is the test 2. Test 3 is whether the service is rendered in an individual capacity as a professional, or it is rendered in a corporate capacity as a corporate entity, because the rules gets changed. And test 4 is whether it's a permanent establishment in India. So why am I bringing specifically this 4 test is because if the answer is different, then the rules are different. So one need to test it from this perspective and then accordingly decide whether it is taxable or not taxable. So management consultancy services, it's taxable because now when I'm saying it's taxable, it is taxable as per Income Tax Act, but it may not be taxable if it is not a make available services, then it may not be taxable. So one need to keep that in mind. Financial consultancy, legal and regulatory consultancy, accounting consultancy, human consultancy, everything, the same rule applies where we need to test from these 4 parameters and decide whether it is going to be taxable or not taxable, right? Let me take to the next point. Uh, Again, the same rule, consultancy services, advisory services. Let me take one example to make you understand how this works. Let's say a strategic advisory services and we go to the same rule. Let's analyze and check whether this pass through is through this test or not. There is a company who has given me an advisory services. The company is based in US and they have given me an advisory services for setting up or executing or expanding my market in US. Okay. Now, question 1, is it for the purpose of business in India or for the purpose of business outside India? Now, let's say if I'm an exporter, I'm going to do everything from India. The whole activity is going to be in India, nothing over there. Okay. In that case, it is sourced in India, it's from a business in India. Second situation, I am not going to do everything from India. There's a lot of activities which are going to be executed in US by an entity of mine in US. Then it is for the purpose of business outside India. Clear? Point number 1. Let's say it's for the purpose of business outside India. Is it taxable in India? Answer is no. Why? Because it is not deemed to accrue or arise in India as we looked into in the whole detail. Number 2. Now we go to the next point and say that, okay, as per Income Tax Act, it is taxable. Let's say, okay. Now we go to DTA and see whether this service as a strategic advisory service is whether it's rendered by an individual. If the answer is yes, then the next question we will see, is the nature of the consultancy definition or professional service definition described under the specific DTA, Article 12 of the Independent Personal Services of the DTA. Now, let's say this consultancy is an engineering service. This strategic advisory is an engineering service rendered by an individual who is an engineer. Okay. Now, whether in that case, what will happen? So you will go to that respective article. That article will decide that whether it is taxable or not taxable. Okay. Situation number 2 is not rendered by an individual, it's rendered by a corporate entity. Now we go to the next point. Is it having a permanent establishment in India? Answer is no. So then we are ruling out that part. Then the next question is whether that service is a make available service. Answer is no, it is not a make available service. If that is not a make available service, then it is not taxable. So my remittance, which will go for a strategic advisory, will not be taxable in India. That's how you have to pass through each of the tests, get the answer for the test, and move forward. Right? Now, for this, you have seen my flowchart, which I have given before, and that flowchart is very useful for you to take a workflow and decide whether it is going to be taxable or not taxable. Yes. Let me check if some importance are left. This I have already covered. Secondment. Grants are not taxable. Marketing expenses, if you are participating in any exhibition and if you are paying a participation fee, it is not taxable. If you are paying any traveling expenses for that, it is not taxable. If you are paying any stall, you bought a stall over there and for that stall you are making a payment, it is not taxable. Subscription membership fees, if you are paying any association fees, which you are participating in any association over there and you're paying a membership fee, it is not taxable. Cloud services, it's not taxable, but with a caution of litigation. But what it says is, because there is no human intervention, it is purely an equipment or a machine which is providing. So let's say tomorrow I went an X-ray for an X-ray, and there is an X-ray report which has got generated, and I got an X-ray report for which I'm making a payment to hospital. Is it taxable? Answer is no, because there is no technical service. There is no human intervention. It's only an X-ray machine which is giving me a report. Okay, but let's say after the X-ray report, I go to doctor. Doctor advised me to do certain things. He gives me a prescription, etc. There's a human intervention. Therefore, it's a technical service, or therefore it's a consulting service. Okay. So human intervention is important. That's what these courts have said. Based on this rationale, courts have said that it is not taxable in India. Yes. I think I'm done. Broadly, I have covered lot of issues which are related to presentation. This is a QR code where there are around 1,000 chartered accountants who all come together, and we all answer each other's query, which are related to any query related to taxation, FEMA, advisory services, or GST. And it is not a my group, it is a group which is available for all the chartered accountants. They all come into it. There is a no nonsense group, no good morning, no thank you, nothing. It is pure raising a query and answering the queries. So for the benefit of everybody, this is the QR code. You can scan it across. It is also available as a part of the presentation where you can scan it and get it logged in. There will be some 3-4 questions related to whether you are a chartered accountant or not, because we don't want anybody else coming into the group, and therefore there will be some basic 3-4 questions to understand whether you are a chartered accountant or not. And then if you are a chartered accountant, you will be admitted to this particular group by the admin. Mind you, this is not my personal group. This is a group which is available for all the chartered accountants answering each other's query into it, and therefore this group is something which is relevant. With this, I end my presentation and open the floor for questions. I'm already seeing 19 questions, 11 chats, and I have another 7 minutes to answer this question. So I'll try to take up all it what is available. Give me 1 minute for me to go on the question answers. Yes. So there is a question which is an Indian resident having a foreign client, okay, and has a source of income. There's an Indian resident having a foreign client and has a source of income. Just give me 1 second. An Indian resident having a foreign client and has a source of income outside India, okay, and incurs FTS expenses with respect to his foreign income, whether it will fall under the exceptions and not chargeable to tax. An Indian resident has a foreign client, okay, and has a source of income outside India, okay, and incurs FTS expenses. So FTS expenses is incurred by whom? Bhavini, can you please elaborate this question, because I see some confusion over there. So if you are allowed to open your unmute yourself and answer the question, this particular point. Bhavini, if you are able to hear me, can you please raise this question? I am not able to understand this well. Until now, yeah, Bhavini, please go ahead.
Hello.
Bhavini, please go ahead.
Yeah, am I audible, sir?
Yeah, you are audible.
Thank you for this wonderful session. So my query is, now of Indian resident has a foreign customer. And because he has a foreign customer, the source, I can say that there is a source of income from outside India. Now he has incurred a foreign expense in the nature of FTS in respect of this foreign client for the purpose of rendering services to this foreign client. Now, would that fall under the exception section 917B?
So basically, the activity for rendering this service, Bhamini, is carried out from where?
Okay, and so we have to see where it is carried out from. If it is carried out from India, then it is the source is said to be in India.
Absolutely. You can go refer to the decision of Havels And the
Okay.
other decision which is mentioned in this presentation, you can take a benefit of that.
Okay. Okay. Great.
Can I
Sir.
go
Thank
ahead?
you. Yes,
Okay.
thank you.
Please throw light on TDS on payments to LinkedIn, Google, Facebook. So basically, all these payments which are now made are basically a social media payments where equalization levy is coming into picture. So you may refer to my presentation, which is already available on Taxmann for equalization levy, which is covering elaboratively on this particular point, that what is going to be the situation for equalization levy when it comes to Google, Facebook, LinkedIn. You may refer to that presentation, and still if you have a questions, you can raise me a question on email, which is darshak@snco.in. Next question is once more about copyrighted article. Copyrighted article and copyright is basically, as I told, if I'm only allowing to use you to use it without any giving any modification rights, any duplication rights, or any changes to be made, I'm not allowing you to do anything of that, then it is a copyrighted articles which I'm giving. Right of a copyrighted article. I have a copyright. Okay. I'm not allowing you. But if you are allowed to duplicate, license, etc., then you are I'm giving you a copyright, and for which if you are making a payment, it is royalty. That is what the difference is. Going next. Okay, just give me 1 second. Yeah. If the salary is paid to non-resident, no need for paying TDS irrespective of the amount. Answer is amount is not material. What is material is that when you're making a payment to a non-resident, he is rendering service outside India, then it is not taxable in India. A subsidiary in India reimburses payroll processing charges to its holding company in UK. A subsidiary company in India reimburses payroll processing charges, okay, to its holding company in UK, whether TDS is applicable. If you have a tax resident certificate and therefore it falls under make available and therefore it is not taxable. So if you have a tax resident certificate, then it is not going to be taxable. Whether subscription charges paid for technical database for a year liable for TDS? Answer is no. If you're not having a copyright, then it is not, because it's a copyrighted article. Now, if there is a design and that design is specifically for you, and if that is shared through a database, okay, where it is not available public at large, it is available only for some specific people who are paying for it, then it is a separate situation. But if it's a general public at large data available and you are utilizing that data or having an access to that particular data, then it is not taxable. Mind you, you need to have a tax resident certificate for this. I am into reselling of virtual token business. Okay. The virtual token is having a value only in the company APP, and it is not a virtual currency. Okay. I purchase a virtual token from US based company and resale in India. Since virtual token is transferred through e-wallet and cannot be physically touched. Okay. Okay. I'm not getting your question. You have not mentioned your question over here, Wasim. Can you unmute yourself and ask this question, Wasim? I'm going further till the time he's coming on the platform. Yeah, Wasim.
Yeah. So my question, hello sir, thank you for the opportunity. So my question is whether in this transaction I am liable to deduct TDS. So
But
this
what
is
is this question, Wasim? Can you please
so
raise?
there is an app like Me Map, or there are other apps where performance where there are performers like singers, musicians comes online and perform live streaming. They perform, they sing, or they dance, or they do some activity, and there are virtual audiences. So this everything is done on the app. The app name is Tango Me. Okay, so there on that app, when you are given a virtual token for attending those apps, and if you like the any if you like the performance of any singer, then you can give those singer, those performers some tokens as an appreciation, and then ultimately these tokens can be encashed by those performers using this app, using the payment gateway facility available on the app. So I am the person who buys this token in bulk quantity from a US based company who doesn't have any presence in India, and then I sell it to the small person who wants to buy it from me in India. So since I buy it from them, I get it at some discount and sell it by keeping some my margin. So when I'm making the payment to the US company, the banks ask me for 15 CSCP. So whether this requires any TDS deduction or this won't be falling under the TDS only.
So Wasim, can we take this particular question offline, Wasim, because it requires a detailed discussion on this. I won't be able to give an immediate answer. So you have my email ID mentioned at the down at the bottom of the presentation. Can you throw me this particular question and can we have a discussion offline?
Okay, sure.
Because this requires a bit detailed discussion.
Yes, okay.
Is
So
it okay?
I'll connect you on email setting.
Sure, let's do that. In case of a purchase of goods from outside India, and if the vendor has SEP in India, then what would be the TDS implication? In case you have purchase of goods from outside India, and if the vendor has an SEP in India, then what will be the TDS implication? So, please give me your view if we had a TRC. So, what is important over here is that whether the purchase of goods which are happening are the title of the goods transferred outside India. Because if the title of the goods are transferred outside India, okay, and this SEP is not having a direct relationship with that particular transaction, then you can very clearly differentiate that this SEP and this particular transactions are different, and therefore that transaction having a title transferred outside India, it is not taxable in India. Now let's take another situation where you SAP is in India and there is a transaction which has a direct correlation. And now the question is whether this SAP is going to be considered to be a so I'm assuming that it is, or I'm not even assuming, I'm saying this is basically an SAP which is beyond the limits which are prescribed. And therefore, the question is whether this transaction will be taxable in India. The answer is yes, it is taxable in India. Wasim, again, so virtual token, we are taking it separately. We'll discuss this. It is important to take SEP confirmation from vendor and no P confirmation. Okay. TRC and Form 10 from every vendor. Whenever any remittance is to be done, answer is yes. You need to do it so that you don't fall into the under the permanent establishment or SEP clause. Because if it is, then you are going to be safeguarded by having a declaration from the vendor. What about abort subscription? Answer is if you are okay, you are not taxable because the distributor in India who has bought this has already must have paid tax. Whenever he is giving you an invoice, he might be giving a declaration. Even if let's say you're buying it online and there is no declaration available, it is not taxable because the distributor who have bought it has already must have paid the tax on that. Going next, I think I'm not able to see the full decision, but let me check. It says that in the Delhi tribunal, it was not mentioned that the amount was received by this in Singapore, outside Singapore. Uh, Mathali, I'm sorry if I'm not pronouncing it right, but can you please raise this question? I'm not getting the full question over you. Are you there, Mathali? Yes. Can you please raise this question?
Hello.
Yeah, ma'am. Yeah. Can you please raise this question?
Hello. Can you hear me, sir?
I'm able to hear, but if you are being,
Okay.
if you can be a
My
bit
question is,
louder.
so if Indian company is making to the Singapore entity outside India, then can we take advantage of the LOB clause and say that it is not taxable? But
Can you be a bit
remittance will
louder?
happen in Singapore.
Can you be a bit louder, Mathali? I'm not able to hear you. Hello. Can you be a bit louder? Okay, now I got your question. Just give me 1 second. It says in the Delhi tribunal, it was not mentioned whether the amount was received by T Global in Singapore or outside Singapore. Okay, the tax authority in fact questioned why LOB clause was not applicable. To which the SSC replied that LOB clause is applicable to capital gain and not fees for technical service. Kindly enlighten that in case of FTS and royalty, even if it is received outside Singapore, then will LOB clause be not applicable and treaty benefits can be availed? Answer is yes, because there has been uh, uh, specific provision under certain treaties like in Singapore, where it is saying that it is should be on a receipt basis. So when it is purely and very categorically covering on a receipt basis, that will overrule, because the treaty has been agreed upon accordingly by the two government, and therefore it will overrule. So we can of course take this particular point in detail in the email which you can share me, and I can give you a detailed discussion about this. But for the limited point, yes, there are specific DTAs which are describing it, and accordingly, if the DTA is agreed between the two governments and they have agreed upon it, then accordingly the LOB clause will not apply. Whether payment for subscription of spatial software used for analysis of human genetics liable for TDS. If it is specifically specialized software available for public at large, then again the same point, it is public at large and therefore a copyrighted article. But if you are having a copyright, then it is not. Even if we have TRC and no PA certificate from uh, our foreign vendor, would it still be checked to the respective DTA agreement to check? The TRC is necessary for us to validate whether a DTA is applicable or not applicable. So to have an excess of DTA, TRC is necessary. What would be the rate of TDS in case of business income? In India, currently it is for individual 30 and for corporate it is 40%. What is the relevance of explanation of 9.2, which says that service is rendered, it would be deemed to arise in India? In fact, 9.2, it is Roman 2, where it says that if it is 9.2, where service are rendered outside India, it is not taxable in India. So, for example, somebody in India, if he is a resident of India, then for the services rendered outside India, it is not deemed to accrue or arise in India. Okay, so there, let's say I'm sorry, for a non-resident, if he is rendering a service outside India, even if the money is received in India, because the services are rendered outside India, as per the section 9.2, it is not deemed to accrue or arise in India. Okay. Next is, so anyway, for this point, also you need to go to DTAA, which says that if you're staying outside India for 183 days, it is not taxable in India. Whether consulting services for the purpose of business in India without make available, however, TRC has not been provided, whether this will come into play. TRC is necessary for you to take the benefit of DTAA, and for 206AA also PAN number or TRC is required. Donation is covered. Answer is no, it is not taxable. Payment made to agencies overseas for exports is not taxable in India, as long as it is for the services which are rendered outside. So if the agents is carrying out every activity outside India, it is not taxable in India. Payment to Shopify for management of website attracts TDS for management of website. Now, see, we need to, you said Singapore, right? So if the management of website and if you have a tax resident certificate, it is not taxable because it is not a make available service. My client is manufacturing company. If some machinery parts purchased or for exhibition expenses are remitted to a company outside India who is a non-resident and have no business in India, documents have been taken for supply. What documents are required? So you are saying my client is a manufacturing company. If some machinery parts purchased or some exhibition expenses are remitted to a company outside India. So if it is a back-to-back transaction where there is no profit element kept by the foreign entity, then it is not taxable. Document you require is just to prove that it's a back-to-back transaction with no margin and therefore it's a reimbursement of expenses. That is that is the document which will be required. And second is no PE certificate is required. If a particular payment is FTS as per Income Tax Act and does not fall under FTS article as per DTAA, if a particular payment is FTS as per income tax and not as per DTA, do we need to refer other article or business profit article? Only if it's as a PE in India, then you have to refer it. If you don't have a PE in India, then you don't need to refer it. You can straight away say that as per DTA, it is not taxable. Yes, I think I have answered all the questions which are there in Q&A. Let me just check on chat box. What is it? Okay. If TDS applicable on attorney fees paid to an Indian private company to US-based attorney for patent applicable application in US having no PE in India. No, it is not taxable because you don't have a permanent establishment in India. It is not taxable. If the TDS applicable for testing paid by Indian company to US laboratories, answer is no, because if it is human based and if it is not make available. So there is no human intervention, there is no make available, then it is not taxable if you have a tax resident certificate. What kind of documents we need to keep for reimbursement expenses? Back-to-back transaction is what you need to prove, and therefore that much document are required. Remittances for online IT support by foreign company is liable to TDS if that company is rendering a service from a country where there is a make available clause, TRC available, not taxable, otherwise taxable. Remittances to foreign to non-resident shipping company. Not having DIT by an agent India is liable for tax deduction. This is basically ocean front and other remittance surpluses. Remittances to non-resident shipping company not having DIT by an agent. So this is, if I'm assuming this is an overseas shipping where it's an international ship, international traffic. So if it is an international traffic and if you have a tax resident certificate and if that particular shipping company does not have a place of effective management in India, then it is not taxable. Otherwise, it is taxable. Okay. Moving forward, payment of advertisement in LinkedIn software. As I said, equalization levy presentation, one needs to get into it because it is in detail. I won't be able to give a straight answer. You need to go into the into the equalization levy presentation where I have elaborately covered it. It's available on Taxmann. You can just need to type it as an author, Darshak, equalization levy. You'll get the answer for this. I am into reselling of, okay, this question has been already discussed by Wasim. My question is whether TDS applicable on this transaction. Software distribution agreement entered between parent in India and subsidiary outside India. Subsidiary sells software to third-party customers located parent in India and subsidiary outside India. So it's a reverse transaction. Subsidiary sells software in third-party customer locally and collects money. When subsidiary pays royalty on such sale to a parent company, what is the tax treatment? So because it's the money which is received in India from a parent from the subsidiary company in India, of course that is going to be taxable because it's a reverse transaction where Indian company is earning income and foreign company is making a payment. Now, when you see from the foreign company tax law perspective, it is the vice versa. What we discuss is the vice versa, which is going to be applicable. Still, if you have the question on this, you can of course raise me a question on email. I'll answer this particular question in detail. UK Google equalization levy point is what you need to check. Payment to a foreign travel agent for Indian travel agency by an Indian travel agency, whether it would attract TDS. If it's a package which you are purchasing, then it is not. However, if you are taking certain services specifically, then you need to see the DTAA and accordingly take a call. But if you're purchasing a package, then it is not. Can we available to get a class notes and recordings of this? Taxmann will of course provide you this, and it is anyway a live presentation available on YouTube. You can anytime refer to it. If training fees paid for a machine purchase is paid outside India, then it is taxable in India. Purchase outside India, if it is transferred out there, it is not taxable in India. Withholding on payment to Amazon, again, it is a equalization levy question which needs to be get it answered from there. again saying author Darshak Shah, equalization levy. You just punch it into the Taxmann portal and you'll be able to get the answer. In case of purchase of goods from for more than 2 crores in 1 year, whether we are liable, no P and this. Yes, of course, you need to get into the SAP point. This is a specific a question which needs to be answered in detail. You can put an email to me. I'll reply to that particular email. If the payment for representative fees or intermediary services outside India are taxable in India, representative fees is not taxable in India as long as it does not have a P in India. Digitally filed 10F mandatory, even though certain service providers have provided physical forms, answer is yes. WhatsApp group link please is available already over here. Otherwise also on the YouTube presentation is live. So you can always scan it and come on to that particular group. I think I'm answering all the questions which are available with this. Of course, if you have still some questions left out, my email ID is available. You can forward me on email and I'll answer on that particular email ID. I'm done with my part of the presentation and I'm handing over back to the representative of Taxmann to take it forward. But thank you very much for being a part of this particular presentation. I hope you would have got a lot of inputs related to it. And my objective while I give any presentation is at the end of the day that the audience should be able to take the benefit of that and get the practical knowledge about the day-to-day affairs which are going out in the practice or in the industry and what are the tax implication of that. Believe me, my team has been working across for almost 10 to 15 days for preparing any presentations which are related to Taxmann or any platforms which we bring it across. This is purely for all of you and taking the benefit of it. Thank you very much. Thank you by wholeheartedly. Thank you.